If you ever use platforms like Venmo, PayPal, Cash App, or Apple Pay to receive money, this new regulation might change the way you file taxes this season. Basically, Congress passed the American Rescue Plan Act of 2021 that promised to go after wealthy tax evaders. The idea was simple: ensure everyone pays their fair share. But here's where it gets complicated. This rule isn't just targeting billionaires hiding their income. It's now set to affect nearly 20 million Americans during the upcoming tax season. I'm here to explain exactly what this means for you so you're not caught off guard. And here's what you need to know. If you receive over $20,000 through third-party payment platforms in a year, for example through PayPal, you'd receive a tax form called a 1099-K from PayPal. But now the American Rescue Plan changed the threshold from $20,000 to just $600. So now if you receive $600 or more during the year from platform like PayPal, for example, then PayPal will give you a 1099-K tax form, and PayPal will also send a copy to the IRS. This means if you fail to include this tax form on your tax return, the IRS will already know because they have a copy of it, and you may face penalties. The goal here is to identify unreported income and catch tax cheats. But let's be real, this change has far-reaching consequences for regular people, not just those intentionally dodging taxes. To make this crystal clear, let's go through a straightforward example. Under the old rules, let's say you sold an old dinner table for $700 and received payment through PayPal. Because this amount was under the $20,000 threshold, you wouldn't have received a 1099-K form. But under the new rule, that $700 sale will generate a 1099-K form that you will need to report, even though it's a non-taxable transaction. If you don't, the IRS will send you a notice because they already have a copy of the 1099-K. So here's the issue this creates. Selling personal items at a loss isn't taxable, yet this rule creates unnecessary confusion and extra paperwork for everyday transactions. Let's take the old dinner table example further. Imagine you bought that table years ago for $900 but sold it for $700. In this case, you lost money on the sale, and tax law states that you only owe taxes on profits, not losses. Therefore, this transaction shouldn't be taxable. But here's the catch. With the new rule, you'll still receive a 1099-K for the $700, and if the IRS audits you, you'll need to prove that you sold the table at a loss. This means providing receipts for the original purchase. And what if you don't have any receipts since it's been years? The IRS may assume you made a profit and could demand taxes on that $700. This is a major inconvenience, especially for items you purchased years ago. How many of us still have receipts of old furniture or personal belongings? It puts the burden of proof on taxpayers even when no profit was made. But listen to this. They are saying that instead of dropping it down from $20,000 to $600, they're going to give taxpayers a break this season. So the threshold for this tax filing season is going to be $5,000. But the rule is still $600. They're just giving an increase for this season. So if you receive a 1099-K, you must keep it and report it accurately on your tax return. Ignoring it could lead to an IRS notice. And mistakes happen. The IRS might mistakenly send out incorrect notices, and payment platforms may also make mistakes when adapting to the new rule. Error like this can create confusion and could cause you to pay more than you owe. And let's clear up some common misconceptions. Non-business transactions like reimbursing a friend, receiving birthday gifts, or getting rent money from your parents are not taxable and don't require a 1099-K. Payments made through Zelle won't trigger a 1099-K because Zelle operates as a bank-to-bank transfer, not a third-party payment processor. The $5,000 threshold applies per platform and is the total amount received for the year. So earning $3,000 through PayPal and $4,000 through Venmo won't won't generate a form from either. Now let's talk about the other ripple effect of this rule change. Even if the transactions triggering a 1099K aren't taxable, you'll still need to include them in your tax filings. This is going to cost so much money for millions of people. For example, if you use a tax software like TurboTax, I do, you may have to pay for upgraded features to handle these forms, and if you work with a tax preparer, they might charge you more for the additional paperwork. The backlash was so intense that the IRS decided to delay implementation of this rule twice in 2022 and 2023, but the IRS commissioner said that the rule is now set to take effect for this tax season. There's still a chance this rule could be delayed again, but for now it is still in effect. And you might want to know, there are bills in Congress that some propose keeping the threshold at $5,000. Others want to raise it to $10,000 or even revert to the original $20,000. And there are lobbyists representing third-party payment processors. They are also pushing for changes. There is so much confusion with this law. Right now, people can't see how this will go smoothly for millions of people. Whether the rule stays or changes, one thing is certain: being informed is your best defense. Let me know your thoughts about this law in the comments below. And thank you for watching. If you want more helpful financial tips, make sure to hit that like button, subscribe for more tips, and leave a comment. See you in the next one.